Let me take you back to a pivotal moment in my life, 1942. I was just 11 years old when I made my first investment. I had saved $14, 75 every penny I could muster. With that modest sum, I bought 3 shares of City Service Preferred. Now, City Service is a well-known name today, but back then, it was just another company to me. This initial investment was the beginning of a lifelong journey. At the time, my understanding of the stock market was simplistic. I believed stocks were merely items that went up and down. I charted their movements meticulously and read countless books on technical analysis. I immersed myself in Edwards and McGee's work, which was the technical analysis Bible then, and devoured hundreds of pages, believing that predicting stock movements was the key to success. In those early days, my focus was entirely on the wrong metrics. I was trying to predict what a stock would do, thinking that if I could forecast the stock market's behavior, I would achieve great wealth. This approach, however, proved to be misguided. It took years of studying and experiencing the market to realize this, but every step in that journey was valuable. My initial foray into the world of stocks taught me the importance of thorough research and the dedication required to succeed in investing. It laid the foundation for my future understanding and success. Though I was misguided initially, these experiences were crucial in shaping my investment philosophy. At that young age, I didn't just buy shares. I embarked on a learning journey that would transform my understanding of wealth and investment. The key takeaway from my early investment days is that starting early, even with small amounts, and being willing to learn from each experience can set the stage for future success. It wasn't the amount of money that was important. It was the lessons learned and the passion ignited. When I was around 19 or 20, I experienced a transformative moment in my investment journey. It was then that I came across Ben Graham's seminal work, The Intelligent Investor. This book fundamentally altered my understanding of investing and laid the groundwork for my long-term success. Until then, I had spent years trying to predict stock movements and the market's direction. I read extensively on technical analysis, delving into the intricacies of charts and patterns, believing that if I could just master these techniques, I would unlock the secret to wealth. But Graham's book taught me a crucial lesson. I had been looking at stocks the wrong way. Graham introduced me to the concept of value investing, which focuses on buying businesses, not just stocks. He emphasized that behind every stock is a real company with real assets, earnings, and management. The market price of a stock, he argued, often deviates from its intrinsic value due to market fluctuations and investor psychology. This was a revelation to me. From that point forward, I began to see stocks as pieces of businesses rather than mere symbols on a ticker tape. This shift in perspective was profound. Instead of trying to predict short-term price movements, I started evaluating the fundamental value of companies. I looked at their earnings, assets, and competitive position, asked myself, would I be happy owning this business if the stock market closed for the next 10 years? This change in mindset was liberating. It allowed me to focus on the long-term potential of businesses rather than the noise of daily market fluctuations. It also taught me the importance of patience and discipline in investing. By holding on to quality businesses through thick and thin, I could benefit from their long-term growth and success. This new approach didn't just make me a better investor. It made me a better thinker. It forced me to look beyond the superficial and delve deeper into the underlying value of things. It taught me to be patient, to think independently, and to trust my own analysis rather than following the crowd. So, my advice to all aspiring investors is this: don't focus on predicting market movements or chasing short-term gains. Instead, invest in businesses that you understand and believe in it. Look for companies with strong fundamentals, a competitive edge, and the potential for long-term growth. And most importantly, be patient. Investing is a marathon, not a sprint. By staying true to these principles, you can achieve remarkable success in the long run. Invest in businesses. You understand this might seem obvious, but it's a principle many overlook. When I invest, I focus on companies whose business models are clear to me. I need to understand how they make money, what their competitive advantages are, and what their long-term prospects look like. If I can't grasp these fundamentals, I simply don't invest. Secondly, focus on the long term. The stock market is full of noise and short-term volatility, but real wealth is built over decades, not days. When I invest in a company, I do so with the intention of holding it for many years. This long-term perspective allows me to look beyond the inevitable ups and downs and focus on the company's enduring value. It also means I'm less concerned with short-term market fluctuations and more interested in the company's ability to generate sustainable growth and profits over time. Thirdly, look for value. This principle comes straight from Ben Graham's playbook. The market often misprices stocks due to short-term factors, creating opportunities to buy quality companies at a discount. By focusing on the intrinsic value of a business rather than its market price, you can find bargains that offer significant upside potential. This requires thorough analysis and a keen understanding of the company's fundamentals, but the rewards can be substantial. Fourthly, be patient and disciplined. Successful investing is not about making quick gains, but about building wealth steadily over time. This requires patience and the discipline to stick to your investment strategy, even when the market is volatile or your investments temporarily underperform. It's important to remain calm and focused on your long-term goals, rather than getting swayed by market sentiment or short-term trends. Lastly, maintain a margin of safety. This is another key lesson from Ben Graham. Always invest with a cushion to protect against potential mistakes or unforeseen events. By buying stocks at a significant discount to their intrinsic value, you reduce the risk of loss and increase your potential for gain. This margin of safety acts as a buffer, allowing you to weather market downturns and unexpected challenges with greater resilience. From a young age, I was deeply passionate about investing. I found joy in reading financial reports, analyzing companies, and understanding market trends. This passion drove me to spend countless hours studying and learning about the intricacies of the financial world. It wasn't work for me. It was a labor of love. This intense interest kept me motivated and eager to keep going, even when faced with challenges and setbacks. Passion is the fuel that drives you to put in the necessary time and effort to master your craft. When you love what you do, it doesn't feel like work. You are willing to go the extra mile, to dive deeper, and to keep learning and improving. This relentless pursuit of knowledge and excellence is what sets you apart from the rest of it. It gives you the resilience to overcome obstacles and the determination to keep pushing forward. But passion alone is not enough. Persistence is equally important. The road to success is rarely smooth or straightforward. There will be ups and downs, successes and failures. It's during the tough times that persistence becomes crucial. It's the ability to stay the course, to keep going despite setbacks, and to remain focused on your long-term goals. In my own journey, there were many times when things didn't go as planned. Investments didn't always yield the expected returns, and market conditions were often unpredictable. But I never let these challenges deter me. I persisted, continually refining my strategies and learning from my mistakes. This persistence paid off in the long run, enabling me to build a successful investment career. One of the keys to maintaining persistence is surrounding yourself with supportive and like-minded individuals. Throughout my career, I have been fortunate to work with partners and colleagues who share my vision and values. These relationships have been invaluable, providing encouragement, insights, and collaboration. Together, we have navigated the ups and downs, celebrating successes and learning from failures. Another important aspect of persistence is maintaining a positive mindset. It's easy to get discouraged when things don't go your way, but it's crucial to stay optimistic and keep believing in your abilities and your goals. A positive attitude helps you stay motivated and resilient, even in the face of adversity. Passion and persistence are two sides of the same coin. Passion drives you to pursue your dreams with enthusiasm and dedication, while persistence ensures that you stay the course, no matter how challenging the journey may be. By cultivating these qualities, you can overcome obstacles, achieve your goals, and ultimately build a successful and fulfilling career. Remember, success is not a destination, but a journey. Embrace your passion, stay persistent, and you'll find that the rewards are well worth the effort. When I began my investment journey, I quickly realized that the stock market is full of noise every day. Prices fluctuate based on a myriad of factors, some significant, others trivial. It's easy to get caught up in the daily ups and downs and to make decisions based on short-term movements. However, true wealth is built over decades, not days. One of the most valuable lessons I've learned is to focus on the long term. This means looking beyond the immediate market conditions and considering the enduring value of the businesses you're investing in. When I buy a stock, I think of it as owning a part of a business. I ask myself if I would be happy owning this business if the stock market were to close for the next 10 years. This mindset shift from stock prices to business ownership is crucial. By adopting a long-term perspective, I can ignore the short-term volatility that often causes panic and poor decision-making. Instead, I concentrate on the fundamentals of the companies I invest in. Their earnings, growth potential, competitive advantages, and management quality. These are the factors that drive long-term success and create lasting value. Patience is a critical component of this approach. The market doesn't always recognize the true value of a business immediately. It can take years for the intrinsic value to be reflected in the stock price. During this time, it's essential to stay the course and not be swayed by short-term market trends or external opinions. This requires a strong conviction in your investment thesis and the discipline to stick to it. Another advantage of a long-term perspective is the ability to benefit from the power of compounding. Compounding is often called the eighth wonder of the world, and for good reason. By reinvesting earnings and allowing your investments to grow over time, you can achieve exponential growth in your wealth. This requires a commitment to hold on to your investments and let them mature, rather than selling at the first sign of profit or panic. Maintaining a long-term perspective also aligns your interests with those of the companies you invest in. Businesses are focused on sustainable growth and long-term success. And as an investor, you should be too. By thinking like a business owner rather than a trader, you position yourself to benefit from the company's growth and success over time. Since my first investment in City Service Preferred in 1942, I've consistently invested in companies that are based in the United States. America has a robust and dynamic economy, and I believe in its long-term growth potential. By investing in American businesses, I've been able to participate in the growth and success of some of the world's most innovative and successful companies. One of the key components of my strategy is to invest in businesses, not just stocks. This means looking beyond the market price and focusing on the underlying value of the company. I evaluate businesses based on their earnings, assets, management, and competitive position. I ask myself if I would be happy owning the entire business, not just a piece of it. This approach ensures that I invest in companies with strong fundamentals and long-term growth potential. Another important aspect of my strategy is to look for value. This means identifying companies that are undervalued by the market. The stock market can be irrational at times, and prices often deviate from the intrinsic value of a business. By conducting thorough analysis and focusing on the long-term value, I can identify opportunities to buy quality companies at a discount. This value-oriented approach has been a cornerstone of my investment philosophy. Patience and discipline are also crucial to my strategy. Investing is not about making quick gains, but about building wealth steadily over time. This requires staying the course, even when the market is volatile or your investments temporarily underperform. It's important to remain focused on your long-term goals and not be swayed by short-term market movements. By being patient and disciplined, you can ride out the ups and downs and benefit from the long-term growth of your investments. I also believe in maintaining a margin of safety. This concept, introduced by Ben Graham, means investing with a cushion to protect against potential mistakes or unforeseen events. Many of the conveniences and technologies we take for granted today simply didn't exist. The advancements in medicine, transportation, communication, and entertainment have been nothing short of astounding. Consider this. When I was young, John D. Rockefeller was the richest man in the world. Yet his standard of living was nowhere near what even middle-class Americans enjoy today. Advances in healthcare mean that diseases that were once fatal cannot be treated effectively. The quality and accessibility of education have improved dramatically. We have access to an incredible array of entertainment options, from television and movies to the internet and live streaming. The way we travel, communicate, and even work has been transformed. These changes reflect the power of innovation and economic growth. The United States in particular has been a fertile ground for innovation. Our economy has grown and evolved, creating opportunities for individuals and businesses alike. This growth has been driven by a combination of factors, including technological advancements, a strong work ethic, and a culture that encourages entrepreneurship and innovation. As an investor, I have always believed in the long-term strength and resilience of the American economy. This belief has guided my investment decisions and helped me build my fortune. By investing in American businesses, I have been able to participate in this incredible growth and prosperity. I look for companies that are well-positioned to benefit from economic trends and have the potential for long-term success. Another key observation is the importance of compounding. The benefits of long-term economic growth are compounded over time, creating exponential increases in wealth and prosperity. This principle applies to investing as well. By investing in strong, stable businesses and allowing your investments to grow over time, you can achieve significant returns. Compounding is a powerful force, and understanding its impact is crucial for any investor. It's also important to recognize that the economy goes through cycles. There will be periods of growth and periods of contraction. As investors, we must be prepared for these cycles and stay focused on the long-term potential of our investments. During downturns, it's essential to remain patient and disciplined, avoiding the temptation to make hasty decisions based on short-term market movements.